Hello and welcome to a new video. Today we are going to be talking about price sequence reading, or what's the same, we are going to try to understand the language of the charts. As I already mentioned in a previous video, I don't quite believe in indicators, so I don't rely too much on them when it comes to reading price action and when it comes to analyzing what's going on the charts. I think the way to go when it comes to trading is to write price in itself without any further extra information. And that's what we are going to be doing in this video. Basically, we are going to be focusing 100% on price, on how price is behaving, how it's developing on your chart, so we can gauge an idea of whether we want to be searching for long entries or short entries. Okay, it's always important to read price, see where price is going, analyze whether we want to search for buy opportunities, short opportunities, or maybe not to search for opportunities anymore because the right market conditions are just not presenting themselves on the chart. All right, let's get going. Okay, we are looking now into a real forex chart, the sterling pound against the Swiss franc on the weekly time frame. Even though the weekly time frame may sound like a very long-term chart, and it is, what I'm about to explain here can be easily applied to any time frame of your choice, all the way from the 5-minute chart, from the very intraday charts, to the long-term charts, like I say, the weekly, the monthly. Whatever your time frame of choice may be, you can apply these concepts. Okay, they are pretty much universal across different time frames. So I've just picked this weekly chart. Later on, I'm going to show you another example with a shorter time frame chart, so you can see that again, like I said, you can apply these principles to any time frame. So, as we've already established, this is a GBP, the sterling pound against the Swiss franc on the weekly time frame. We are going to be reading price action, and for that, firstly, we need to define what's a swing high and what's a swing low. As you know, guys, price it never moves in a straight line. Okay, price likes to swing up and down. Okay, in waves, sometimes with a clear bias, either to the upside, in which case we are uptrending, or to the downside, in which case we are obviously downtrending. But nonetheless, price moves in swings. Okay, in let's say in waves, both to the upside, to the downside, within the overall major move, the overall major bias. Now, this is a downtrending market. It's rather obvious. Price is going down. Okay, that's rather obvious. We can clearly see it with a quick look on the chart. Actually, let me zoom in a little bit. Okay, right there. As I was saying, this is obviously a downtrending market. Price is going down, but it's not going down in a straight line. As you can see, price is zigzagging as it moves down. Price does so in a waving pattern. Okay, this is a very typical. It's the way price moves. Why does it behave like that? No one knows. Price tends to swing up and down for no particular reason than just its very nature. Okay, price on its very nature is a swinging beast. Okay, as you can see, price likes to move up and down in a waving manner. Now let me go back here. So as price swings, it forms swing highs and swing lows. Again, if this is the swinging pattern, this is a swing high and this is a swing low. Okay, it's basically the turning points within the swings. Swing high, swing low. Swing high, swing low. Swing high, swing low. And so on and so forth. All right. Now, defining what a swing high or a swing low is, it's not really, there's no an standard definition. Everyone has their own definition. Some people, for example, if we pick this swing there and having a swing high right there, some people would define the swing as a bar where the high for this bar, meaning that point, is surrounded by lower highs. For example, these bars there have clearly lower highs, and if we go to the left, we can see the same thing. Okay, the previous bars also are showing a lower highs for those individual bars. Okay, so basically, some people defined a swing high as a bar surrounded by lower bar highs. Now that's good. That's good. That's a very obvious definition. Myself, I would advise you to not get too caught up on the definition. Okay, sometimes keeping things simple is much better. Okay, much more intuitive. So if you take a look at your chart, and you can easily define a zigzagging pattern, every turning point within that zigzagging pattern are the swing highs and swing lows. No need to, establish a textbook definition. I'm very much against theorizing too much when it comes to trading. Trading is it's more of a practical thing than a theory thing. So, my opinion, don't get too caught up on definitions. If you can clearly see the pattern, just mark the swing highs and swing lows in your chart, which I'm gonna be doing right now. Firstly, I'm going to be marking the swing highs. That's one there. Another one there. Actually, I'm going to pause the video and I'm going to mark the swing highs and the swing lows so I'm not overstretching the video too long. Just bear with me 1 second. Okay, I've marked the swing highs and swing lows with red arrows, which are representing the swing lows, and blue arrows representing the swing highs. Now, as you can see, price in this part of the chart is basically making lower swing highs and lower swing lows. Okay, it's very easy to identify how each different swing high, each different arrow is lower than the previous one, both swing highs and swing lows. Okay, do you see that? Do you see how swing highs and swing lows, we are consecutively making lower swing highs and lower swing lows? That's the definition of a downtrend. Okay, when price is making lower swing highs and lower swing lows, it's a clear signal that we are in an established downtrend. As long as price is making lower swing highs, lower swing lows, basically as long as we are in a downtrend, we want to be searching for short opportunities, for short entries. That's the conservative way of trading a trend. Always trade in the direction of the trend. It's a rather common expression in the Forex lingo, or in the trading lingo. The trend is your friend. And it's actually true. Okay, it's always much easier to trade in the direction of the overall market bias than trading against. Let's say it increases your statistical chances to score a winning trade when you are swimming in the direction of the flow. Okay, and swing trading is all about swimming in the direction of the flow. So, if your chart is making consecutive lower highs, lower lows, you want to be searching for short opportunity, as long as those as the market continues going, in this case, in a downtrend. Okay, as long as price continues moving, making lower swing highs, lower swing lows, and therefore moving to the downside, you want to be searching for short opportunities. Now, that happens here, until there, and right at this point, we've broken the downtrending pattern, because we've made a higher swing low. Do you see that? Okay, lower, higher. Something is not right there. Now, that doesn't mean that we are turning from a downtrend into an uptrend. In fact, we are not scoring higher swing highs. Okay, we are still making lower swing highs. But it means that price, or at least this market, is going through a period of congestion. The downtrend has taken, let's say, a break, and until the lower swing highs, lower swing lows pattern goes back in place until we can break this upswinging pattern, or higher low pattern. It might be safer if we stop searching for short opportunities until, again, like I say, this period of congestion it gives way either to the upside, in which case we will be probably starting an uptrend and therefore the downtrend will be finished, or until we break this congestion pattern to the downside and therefore the previous downtrend is resumed. Okay, let's scroll to the right. Let's see how price developed over the following days. Right there. Okay, I've marked the swing highs with red arrows, swing lows with blue arrows. This is the congestion part I was talking about before. Price was coming from a downtrend, making lower swing highs, lower swing lows, and right there price breaks that pattern, makes a higher swing low, and therefore the downtrending pattern is broken. In fact, what we are doing, effectively doing, by scoring lower swing highs and higher swing lows, is basically price is basically compressing. It's been going through a period of congestion in a triangular pattern. Okay, when you are obviously making lower swing highs and higher swing lows, basically you are forming some sort of a triangle. Do you see that in my chart? A triangle is, again, as I said before, nothing but a congestion area, and what we need to do in order to continue searching for short opportunities is to wait for this congestion part of the chart to give way, hopefully to the downside. Since we were coming from a downtrend, it's always safer to trade breakouts, to trade moves in the direction of the previous move. Okay, we are coming from a period of downtrending price action. We go through our triangle, right there, price compresses. It's always a safer bet to when price moves breaks to the downside in order to trade a potential continuation move to the downside than it is to trade a reversal pattern. Okay, this depends on whether you want to be a conservative trader or an aggressive trader. Don't you worry, we are gonna be touching extensively on both sides of trading, both aggressive and conservative. If you are to be a conservative trader aiming to, let's say, trade higher quality setups, you want to trade mostly congestion patterns instead of reversal patterns. Okay, but don't you worry, we are going to be talking extensively about this on future videos. So, congestion area, guys. We are not making lower swing highs anymore. What do we need to do? We need to begin making lower swing highs and lower swing lows again in order to confirm that the downtrend is resumed. Now, the question is, when exactly do we determine, or how exactly do we determine whether the downtrend is resumed, or in other words, whether the congestion area, the triangle we were just talking about, has given way or has been broken? And there are two ways of determining the breakout of that congestion area, and therefore to begin searching for the waving pattern, the lower swing highs, lower swing lows pattern. Okay, those two ways are, well, one of them is the conservative way, the other one is the aggressive way, and I'm gonna explain both of them to you. Now, this was the problematic area, right? That was the area where the downtrending pattern, actually these two swing lows were the problematic points in this overall downtrending bias or downtrending markets. Okay, those two were the nasty guys that were setting up some problems, some doubts in our charts. So since those two are the problematic areas, we are gonna mark them with I'm gonna mark it in black, for example. Since those two were the problematic areas, we are gonna mark those two levels with horizontal lines. Basically, we are gonna mark the price these two price levels right there, 193.67 and this one 199.95. Those were the problematic, let's say, turning points where price broke the downtrending pattern with that higher swing low. So again, how do we establish that the downtrend is resumed? Two ways, conservative and aggressive way. The conservative way is breaking from the outer limit, from the outer boundaries of the problematic area in order to determine that the downtrend is in place. That happens there, right there, okay? The outer boundaries of the congestion area gives way right there with a lower swing low, okay? Lower swing low, while price is again making lower swing high. So at that precise junction of the chart, the downtrend is resumed and we have green lights to continue searching for short trades. The aggressive way, being aggressive usually means when it comes to trading that you want to squeeze as much your entry point so you enter as soon as possible in the next potential move. So the aggressive way of trading, the breakout of the congestion pattern, is to mark the inner boundary of the problematic area and wait for the breakout right there. Okay, two ways of trading, or not actually trading, but determining that the trend is still in place, the downtrend is resumed. Conservative and aggressive. To sum it up a little bit, the conservative way, is mark the extreme boundaries, wait for the breakout, and as soon as the breakout happens, continue or begin searching for the lower swing lows, lower swing highs pattern. Once that takes place, we have green light to begin searching for short entries. The aggressive way is basically doing the same thing with the inner boundary, which is that one. Wait for the breakout and then begin searching for the lower swing lows, lower swing highs. Once that happens, we have green lights to search for short opportunities. It's basically the same principle. It's basically the same ideas. It's just a matter of when exactly to consider that the problematic area has finished. The aggressive trader considers that this is the problematic level, the problematic price level, since it's when price moved up and scored a higher swing low, and therefore that's the level he marks. Waits for the breakout, and after the breakout he waits for the lower swing low, lower swing high pattern to determine that the trend is in place. The conservative trader, well, he wants to know nothing about all that. He wants to make sure that the entire problematic area gives way, and therefore he marks the extreme boundaries of that congestion area, waits for the breakout. After the breakout, he waits for price to begin making lower swing lows, lower swing highs, and then he gives himself the green light to, the thumbs up to continue searching for short opportunities. Basically the same thing, just two trading approaches. Depends on, as I was saying before, how early you want to get into the trade. Second, what type of confirmation do you want the price to give you before searching for trades? And third, the let's say level of quality you are willing to take on your trades. If you want to take a higher quality trade, well, I'm afraid you'll have to wait for the entire problematic area, the entire congestion area, to give way. If you want to get earlier, but you are willing to sacrifice a certain degree of quality in your trading signals, and therefore probably scoring a lower win-loss ratio in your trades, well, you simply mark the inner boundary, the inner limit, and from there just wait for price to begin swinging down. Okay, so yeah, that's another decision you are gonna have to take sooner or later. Just as we saw on a previous video that every trader needs to determine his or her time frame of choice, you'll also have to decide on your degree of aggressiveness in your trading, because even though the actual trading tools you are going to be using on a daily basis are going to be the same, how you actually apply or when you actually apply those tools may vary depending on, again, what type of confirmation you are going to be requiring from your trading setups. So yeah, as I said before, sooner or later, it doesn't have to be now, okay? It doesn't have to be right now when you are starting your this trading coaching program, but sooner or later you'll have to decide on on whether you want to be an aggressive or a conservative trader. Okay? Now, continuing with the video, once we've established that this problematic area, this congestion area, has given way either there or there, again, depending on whether you are a conservative or an aggressive trader, and once we confirm that the lower swing high, lower swing low pattern is resumed, and therefore we go back into downtrending mode, it's time to continue reading price action, to continue marking the swing highs and swing lows on your chart, expecting to, get a lower swing high, lower swing low pattern, and as long as the downtrend is in place. Now, that goes all the way until there. Actually, let me zoom in a little bit more. Okay, right there. And we can clearly see how at this price the downtrend pattern gives way, and we go into another problematic area. Take a look at how we score a final lower swing low, a final lower swing high, but here, things go wrong. We score a higher swing low, and right after we get a higher swing high. So the entire zigzagging downward pattern is broken right there. Okay? At that precise junction of the chart, the zigzagging pattern, as I said, is broken. In fact, from a technical point of view, now we are uptrending, because if you remember at the beginning of this video, we established that a downtrend was a series of consecutive lower swing highs, lower swing lows, and an uptrend was just quite the opposite, a sequence of higher swing lows and higher swing highs in the price action pattern. And that's exactly what's happening right now. Okay, that's exactly what's happening right now. Now, this doesn't mean we should be searching for long opportunities right away. Not at all. That would be way too aggressive. This just means that for the time being, we want to stop searching for short opportunities until, again, the downtrend is resumed. And when is the downtrend resumed? Well, again, once we break this higher swing high, higher swing low pattern. Basically, what we want, if price was zigzagging down and then it turns around and begins zigzagging up, which is what's happening right now, what we want is price to begin making lower highs and lower lows. Okay, it's basically the same thing. Price was zigzagging down, then it began zigzagging up, and if we want to continue searching for short opportunities, what we want is price to turn around once again in the direction of the overall market downtrend. Okay, that's basically what we want to wait for. Lower swing highs, lower swing lows, again in the direction of the overall trend. If that doesn't happen and price continues zigzagging up, well, in that case, we will have to just completely forget about this downtrend. The party's over, and we'll have to begin searching for up moves, for buy opportunities, Because price is telling us so. Price is telling us that price begins to or wants to go up by scoring continuously higher swing highs and higher swing lows. At the end of the day, price action reading, especially at these very basic levels, please guys remember that we are just beginning with a coaching program. We are let's say building up the basement of the price action reading house. We still haven't gotten into the advanced techniques. We are just covering the basics here, but price action reading, when it comes to determine the direction of the market, which is all what we are doing here in this video, guys, we are just reading price in order to determine whether we are uptrending, downtrending, or not trending at all. Basically, we are moving sideways. So as I was saying before, price action should be kept simple. There is no need to overcomplicate things beyond necessity. All you need is to mark the swing highs and the swing lows in your chart with arrows or whatever instrument you may want to use, and then simply read whether those swing highs, swing lows are going up, are going down, or they're basically going nowhere. And therefore we are ranging sideways. Let's go back again. Swing high, swing high, swing high, swing high, swing high. We are going down because we are scoring lower swing highs. Lower swing low, lower swing low, another one and another one and another one. We are going down. This is downtrend. We want to search for short opportunities from here to here. At this point, what happens? We score higher swing high. Higher swing low and lower swing high. So basically, price is compressing sideways. Price is moving within a congestion area, and we do not want to search for any opportunities because in order to make money, price cannot be moving sideways. Trying to make money when price is going nowhere is absolutely financial suicide or trading suicide. You need price to be moving in one direction. You need price to have a clear market bias in order to make money in Forex or to make money in any speculation market. When price is showing no directional bias, like here, okay, price is triangling, is compressing, is squeezing tighter and tighter and tighter. You cannot make money. If price is neither moving up or moving down, you cannot make money because price is not going anywhere itself. Okay, you need price. You need to wait for price to show its true colors. Right here, trying to trade here, as I said before, is trading suicide. Okay, so as long as price is not making either higher swing highs, higher swing lows, or lower swing highs, lower swing lows, you don't want to be trading. Okay, you don't want to be trading because there is no clear market bias. And if the price doesn't know where it's going, how are you supposed to know where it's going? If the market signals are not clear, how are you supposed to get clear trading calls, clear trading signals? It's just impossible. Okay, you want to wait. Once you see this type of price action, you want to see price beginning to show a clear market direction. In this case, again, to the downside. Okay, and furthermore, as price continues to develop, it continues to print lower swing highs, lower swing lows, until here at this junction, maybe it's time to not trade anymore, to not search for short trading opportunities anymore, because the market is giving you conflicting signals. It's giving you higher swing highs, higher swing lows, which is not a good idea or not a good indication when you were searching for short opportunities. Okay, until this higher swing highs, higher swing lows pattern is reversed, you will not be searching, or you should not be searching as a conservative trader or as a, let's say, a non-cowboy trader. You should not be searching for short entries anymore. Now, if this upward zigzagging pattern continues to develop, well, in that case, as we were saying before, the market, the downtrending market is completely over, and it's time to begin searching for uptrend trades, meaning for long opportunities. All right. So, wow, that's been over 30 minutes talking here. It's time to wrap up this video. What I'm gonna do now to finally drive the hopefully drive the point home is I'm gonna be pulling out some random charts, and I'm going to be reading price action for you, showing you different examples, so you fully get the idea of how to mark swing highs and swing lows on your own chart. Okay, we are looking now into the euro against the American dollar on the daily time frame. Just a random chart I've picked. Later on, I'll take another one on a different time frame, so you see that price action reading basically is pretty much universal across all time frames and all currency pairs. But in this case, it's the euro against the American dollar daily time frame. Remember what we are searching for here, guys. What we want to determine is price direction, whether price is going up or going down, and for that we are only be looking to find two specific combinations or swinging patterns, and that's higher swing highs and higher swing lows, meaning that the price is uptrending, or lower swing highs and lower swing lows, meaning the price is downtrending. Any other price swinging combination, okay, any other type of price formation, we are just not going to be interested in, because it will mean that price is not really showing any specific market bias either to the downside or to the upside. And if price, remember what I said before, if price is not showing a clear bias, if price doesn't know where it's going, you cannot know where it's going yourself. You cannot know in which direction you should be trading. So only we'll be searching for higher swing highs, higher swing lows, or lower swing highs, lower swing lows. Now that's a bit of a mouthful, I know, but as soon as we get going, you'll see what I mean in the chart. Okay, swing high there. That's the highest point of the chart. Let's begin there. High swing high, lower swing high, lower swing high, swing low. We don't really have any swing low, any turning point all the way from here to here, so that's a lower swing low, lower swing high. We are downtrending. Keep on pushing back. This is another swing low. We don't really have that much of any other swing low in between. We have a little swing low there. My recommendation is not to don't try to pinpoint every single swing high and low. Mark only the obvious ones, okay? Otherwise, otherwise you're gonna get confused. It's better to just pick the main swing highs and swing lows. For example, here we have one swing high and we have another one there. Okay, do you see that in my chart? Swing high and lower swing high there. But this one is just so small and so tiny that marking that, if you mark every single swing high, such as this one here, this one here, this one here, if you get to mark every single swing high and swing low, you're gonna end up with hundreds of little marks in your chart, and it's going to be counterproductive. Remember what we said before, keep things simple. No need to overcomplicate trading, no need to overcomplicate your technical analysis beyond necessity. So just mark the main swing points. Here's one, there's another one there, another one there, another one there, and another one there. We are still making lower swing highs, guys, and lower swing lows, so we are still downtrending. Another swing low there, maybe a very tiny swing high there. Depends on whether you want to get really picky with your swinging turning points, but at any rate we're still making lower swing highs and lower swing lows. Lower swing low, lower swing high, so we are still downtrending, still searching for short opportunities. The market is still biased to the downside. Oh, take a look there. Higher swing low, lower swing high. Price is congesting. We just saw that before in the previous chart. Remember, guys? This is a problematic area. Now, in this type of price action, you need to determine, as I was saying before, whether you want to be aggressive or conservative and trade accordingly. Mark the horizontal levels, mark either this level or this level, and wait firstly to for price to break either of them, and then begin making lower swing highs, lower swing lows, lower swing highs in order to continue with the downtrend. So these are the two levels we are gonna be marking in our chart and see where we get a breakout or not. Lower swing high, lower swing high, lower swing high, breakout, lower swing low, lower swing high. We'd be searching, as soon as this low gives way, we'd be searching for short opportunities. Remember what I said before, once the breakout takes place, we'll be searching for the low swing high, low swing low pattern to continue. So low swing high, lower swing high, breakout, lower swing low, and now once this low gives way, we'll be searching for short opportunities. That doesn't quite happen. Now it doesn't really happen. We don't really get a lower swing low there. So we're not still searching for, we are still not getting a clear market bias. Price has again made a higher swing high, still making lower swing highs, but is not making lower swing lows. So the bias is still not clear. Once you get this type of price action, very unclear price action, where we thought price might be breaking from an aggressive point of view, but right afterwards it makes another swing high. The best thing you can do is just go for the extreme boundaries. Go conservative, guys. Well, when you get too many conflicting signals in your chart, just mark the extreme boundaries in your problematic area. Mark the extreme boundaries of your range, and from there, just wait for a breakout to either side, because right there we are not really getting clear price action. Price is meandering sideways, kind of taking a piece, if I may say so, and it's not a beautiful price action formation. Price is not really showing any any clear market direction as we saw in this part of the chart. In fact, even we don't really need to mark swing highs and swing lows to see that price is basically zigzagging sideways. Okay, so that's not what we are looking for here. Therefore, when you get this type of confusing price signals, just play it safe. That's my advice. Mark the extreme boundaries of the problematic area and don't search for any trade until that problematic area, that range, gives way either to the upside or to the downside. That happens right there. Price breaks to the upside, and therefore now what we want to begin searching for is higher swing highs and higher swing lows, since price is broken the previous downtrend. Okay, breakout there. This is our last swing high and our last swing low and our last swing high. We get a higher swing high, we get a higher swing low, but immediately after, again, what do we get? A conflicting signal. Again, what do we get? A lower swing high. So the uptrending we were searching for hasn't confirmed. It's not quite panning out. Okay. Moreover, we get that lower swing high that we were just talking about, and moreover, we get a lower swing low. Therefore, not only we didn't get an uptrending market action, an uptrending swinging zigzagging formation, instead we are getting the opposite. Price breaks out, runs with quite a high momentum actually to the upside, but from there it begins downtrending again. Lower swing high and another lower swing high and another swing low. We are in the downtrend, guys. We are searching for short opportunities here. Lower swing high, lower swing low, lower swing high, lower swing low. Well, it's a tough call there. We do make a lower swing low there, but then we make a higher swing low there. Okay, price is really not really showing any clear market direction. Again, what do? Just mark the extreme boundaries of the problematic area. Extreme boundaries. Once price gives way, we are gonna continue searching for our swing high, swing low pattern. Price gives way, and let's begin counting swings again. Lower swing, the breakout took place there. Our previous swing high was there. Our previous swing low was there. So lower swing high, lower swing low. We're in a downtrend. Another swing low there, and well, this is current market price. For the time being, we are downtrending as per the price swings. Take a look at the price swings. We are clearly marking lower swing highs. So price has been downtrending. A little bit of a confusion there, okay, with that almost three, in fact, there were 3 different lows at the same level. What happens when we get confused in price action, or when price swings, price highs, swing highs and swing lows are not going in one given direction, such as in this case? Mark the stream boundaries, wait for the breakout, and once the breakout takes place, begin counting again. Swing low, lower swing high, lower swing low, and so on and so forth. This is current market price. We'll need to wait for for the market to continue moving, but we know we want to search for short opportunities in this downtrending market as per the swing information. Okay. So as you can see, determining the direction of price is rather simple. Just count the waves, count the price swings, make sure they both the highs and the lows go in one direction. Whenever there is some confusion, whenever you are getting conflicting signals between the direction of the highs and the direction of the lows, that means that you are probably going through a congestion area. Therefore, you don't want to be trading until the boundaries of that congestion area give way to either the upside or the downside. So as you can see, no need to really complicate this thing. It's rather simple.